Welcome everybody, Dean Anderson here from Kernel. Pleased to be joined by Head of Index Investment Strategies at S&P Dow Jones Indices, Tim Edwards. Welcome.
Hi.
Hi Tim, so I thought today we'd just do a little bit of a dive, a good chance to touch on recent SPIVA results that have come out and have a little bit of a general conversation on what we've seen over the past 20 years of this data and how that's playing out in terms of the current market environment. So do you want to talk a little bit about, reminder for everybody, what is SPIVA and some of the insights you've seen?
Sure. First of all, our SPIVA scorecards, as hopefully many of the viewers know, but if not, allow me to introduce you to them. They're a series of global reports that reports statistics on the performance of actively managed funds. The report itself is deep and contains lots of data. The statistics that journalists and many others tend to focus on is the simple beat rate over the past year, 6 months, 2 years, 10 years, how many actively managed funds beat the index for their category. So how many large cap US equity funds beat the S&P 500 and so on. The most recent reports that were published cover up to the halfway point of 2022. And there were reasons that made these reports particularly interesting. And the context here is if I paint you a picture about some of the things that have been challenging active managers in recent years, or that active managers have painted as a challenge, and what the conditions were this year. So first of all, it was a bear market in equities.
Yeah.
In a long bull market, one of the observations made was, well, it's hard to outperform the market when it's just going up. There's no advantage in tactically taking on a bit more cash to manage against that downturn. Secondly, there was very high dispersion, i.e. the difference between winners and losers. This was most clear if you look at US equities in the performance of different sectors. So energy did fantastically well, while those big tech heroes in the communication and infotech sectors did particularly badly. So, huge advantages to picking winners over losers. Thirdly, fundamentals mattered in the sense that for many years we'd seen strong performance from growth stocks. Some saying, this is just ridiculous; it's being priced to insanity. But value companies, those with better fundamentals, were lagging behind. Well, that changed in 2022. Value had its best half a year for I think 15 years, and finally, the very largest companies in the market, so the Apple, Google, Facebook, Amazon, you know who they are. They also, in a related sense, they also performed less well. The rest of the market did really well. So when you add those all up, those sound like they could be perfect conditions for active managers to finally shine. Well, what were the results? I hear you asking. So over those 6 months, and in the largest category,
so this is to end of June.
Yeah, so the first 6 months of the year, 51% of actively managed funds underperformed.
Yeah.
So, I mean, the good news is that that's actually the best underperformance rate since 2009. If it continued until the end of the year, I guess the bad news is they're going to need to do a lot better if they're going to change the longest term statistics, which still have 9 out of 10 actively managed funds underperforming over 15 years. Those results were echoed, I should say, in Australia, where it was pretty much a coin flip. And obviously there was a range of results across the different regions that we cover. I mean, look, they're all free to access. Go to our website, search for SPIVA, and you can see how active managers were doing elsewhere.
What do you think that means going forward? We've had these strong factors that should support active, and obviously we can't call what will come ahead. But historically looking, if we go back to your example of 2009, where factors like these do tend to pop up, rising dispersion, those sort of things, they tend to be still, in the scheme of things, relatively short windows for opportunity to add. Do you suspect then that this starts to, again, coming back to those long-term stories, do you think the boat has almost sailed in terms of the opportunity to kind of change the long-term stats here, or is it just going to be still too challenging going forward?
I think the key there and the important thing to think about here is professionalisation, and I'll explain exactly what I mean by that. So um, it's a sort of mathematical certainty that we can't all be above average, right? For anyone to beat the market, someone else who's invested in the market needs to be behind. And the key thing becomes, okay, so assuming that there's a strong connection between performance and skill or insight, which there should be. It's not, am I skilled or talented or am I not? The question is, am I more skilled or talented than everyone else? Right? It's a competition to get this alpha, if you like. And 50 years ago, say, when you were transacting on the New Zealand or the Australian or the US stock exchange, there's a decent chance that the person you were trading with was an individual investor who'd maybe read about a security that they liked, or a retiree who was selling off some of their stocks in order to fund purchase or their lifestyle. Nowadays, the process of trading and investment management is incredibly professionalized. It's gone from, in the US, it's gone from the majority of trades being done by retail investors to the vast majority, something like 95% being institutional trading. So the challenge of remaining ahead and being smarter than the average punter is now much, much harder than it was. And you don't need to take my word for it. If you go to any sort of investment conference and you listen to the portfolio managers and the strategists that actively manage funds, I guarantee you will not ever hear one of them say, "Oh, it's getting easier. This is great times." Instead, what you will hear time and time again is it's ruthlessly competitive, and it is incredibly hard to beat the market. So, on that basis, I think it's hard to see a really big change in the trends. It's just a super fast, super professional market, and being above average has never been harder.
And the dispersion is another factor that plays in here. And that, as to your point, that's the difference there between sort of the best and worst performing. And you can kind of look at that from a few lenses, right? Obviously, at the individual security level in the sector. Am I right in thinking that most of that to date this year has actually predominantly been within the sector dispersion rather than...
Yeah, so there have certainly been opportunities for outperformance in 2022. I mean, I mentioned energy as just something.
The difference is
the market did. It really followed a different path to the rest of the equity market. We've also seen quite, compared to normal, more extreme reactions to earnings. Like those who did well were really rewarded by the market. Those who did badly were really punished. And there is certainly more opportunity for outperformance if you get it right. That I think what one has to emphasize here is that same opportunity is opportunity for embarrassment. And if you got the decision wrong, you were punished much more than you normally were. And there has been, it's been a very tiring year in terms of just the news flow and the unpredictability of it. I think that's not it's not going to go away. That's life, I'm afraid. But yeah, so there has, I guess to answer your question more directly, there has been more opportunity this year, but it's been opportunity for embarrassment just as much as opportunity for outperformance.
Have you seen any changes in terms of, from an active versus index as a tool and a structural point of view, from advisors, wholesale groups globally, given the market conditions? Has this slowed down the adoption of indexing because people are thinking that the opportunity is there and want to try and at least have a go at that? Or are you still seeing a consistent view there in terms of the use and rise of indexing?
So I think one of the things that has been certainly in the sort of institutional space and large pools of capital, there is or there has been this year. There's been high volatility, and there's also been liquidity has been more ephemeral or more difficult to secure. People may not know, but in the UK, we even had a liquidity crunch in UK sovereign bonds. That tells you that things are getting hard to trade. When things get hard to trade, what you see institutions doing is moving towards more liquid, more transparent instruments. And some of the most liquid instruments in the world are index funds, index futures, as opposed to individual securities or actively managed funds or private equity funds and so on. So there's quite a natural focus towards what people can understand, what people think they can value, what people think they can trade, and I think that's likely to continue if things remain as challenging as they are. But more interestingly, in the wealth space, a trend that I think I've seen for some years, but is strengthening, is the way in which advisors are changing their value proposition. Right. So rather than my value proposition as an advisor being, I can find you the best stocks, I can get you access to the best managers, which, by the way, puts you in opposition to your client, because if they don't do well, that's your fault. Is they're changing that to be, I will help you build a portfolio to achieve certain objectives, be that this degree of risk, or this degree of income, or this degree of diversification, and then using index-based solutions in order to complete that whole picture. That puts you on the same side of on the same journey as your client. And so that it's an innovation in process, but it's one that I find very interesting, and has certainly been, I think, part of a catalyst or a driver of the interest in transparent solutions like index funds.
We've very much seen that here, even just within the last sort of 5 years, that shift towards being less about investment advice to more about the planning and the outcome focus and the structuring. The things we actually advise there is adding value. It's actually what, more often than not, most of those clients are going to an advisor for. Most people don't go to an advisor because they want to be told about 15 different fund managers and XYZ stock. It is about the outcomes and pathway. Obviously, I guess another big thing there that comes into that is also the benefit of the cost efficiencies of being able to then implement that strategy that comes from an indexing. And you run some numbers, obviously, on this in the US, just generally at a high level of how much indexing is saving investors.
We have. So we updated this quite recently. It runs up to the end of 2021. What the analysis did was, so we keep track of the total amount of assets, tracking our indices in index funds, and we focused on some of our more popular indices. So this was the S&P 500. Plus our US mid caps and US small caps indices, the 400 S&P mid cap 400 and S&P small cap 600, and then we ran an analysis that ran back over time, looking at the fees that investors were paying in those funds, and then supposing that they had chosen them instead of an actively managed fund operating in the same space. So the fee on the index fund might have been, let's say, 10 basis points. And then year on year, we looked at what was the average fee at that time for an actively managed fund, which might be, say, 60 basis points or higher a while ago. And then that allowed us to estimate how much in savings these index funds had helped generate to investors. The total cumulative figure that we were able to calculate, not adjusted for inflation, just how much in dollars and cents has been saved since 1996. The grand total, $403 billion in savings. That's a very, very material impact that ultimately is money that's been kept by end investors.
Yeah, it's something obviously that is becoming increasingly relevant here in the context of the New Zealand market, being relatively small. We do have Kiwis, which is now sort of starting to reach its maturity here, where the average balance is getting to the point where people are becoming more engaged in it. It's enabling New Zealand to also do more things that we haven't been able to previously in terms of investment in infrastructure and our economic growth. But with Kiwis approaching $1 billion now, it has become $100 billion. It is becoming increasingly on people's radar the quantum of fees that collectively, in a country of 5 million people, how much we are paying. And that's starting to hit $700 million a year. And when we look over the next decade where KiwiSaver assets is going to double or more, based on our growth rates and everything else, we're looking to hit sort of by the decade, end of the decade, sort of between $200 and $250 billion. And similar sort of analysis from us taking that average industry fee at the moment and its decline, plus what would happen if 10% shifted to a lower cost solution. It saves about $1 billion in fees. And that's quite significant again, particularly when you put it in context. The dollar itself may not be big in the global scheme, but in the context of 5 million people, these are quite significant numbers, and I think people are becoming increasingly aware of it. And some of those factors that drive towards the challenges of active and stock picking. One of the other really unique factors, though, that we have in New Zealand that I think there's a general sense that maybe people look at the New Zealand market and go, it is relatively small. It's not that liquid in terms of the total trading volume that we see here. There should be some inefficiencies that surely this is a market where active would outperform and somebody should have an edge because of those inefficiencies. What we anecdotally are increasingly starting to see commentary on here, though, is because of KiwiSaver, is an issue around capacity constraints here. So we actually have very few active fund managers in New Zealand. We actually have very few fund managers generally, and predominantly all of these active managers have KiwiSaver funds. And as KiwiSaver assets are doubling and doubling and doubling, what we've now got is an issue of their areas of expertise is Australasia or New Zealand in particular, but they're managing so much money that keeps on growing. It just becomes harder and harder to actually physically even execute on the insights that they may have. So some interesting nuances, but I think broadly that would tie into seeing similar or expect to see similar statistics in New Zealand that you would see with SPIVA and any other market, despite a general, probably historic view that there were some inefficiencies here. I guess looking forward, and we look at the growth of indexing, and we're sort of really starting to see a change in the conversation and narrative here in New Zealand. I think even from many people know they've been involved in the space for a while now, and even in the last sort of 5 years, that sort of shift in the market and understanding of the nuances of indexing. What is tracking difference? What is tracking error? Getting away from, it's an index. We're starting to get that more depth of understanding, and I guess with technology and data insights, a lot of things are starting to evolve very quickly within the space of indices and what S&P yourselves can physically even deliver now. What do you see some of the trends going forward within index development and what S&P has sort of areas of growth?
So first of all, thank you for the chance to talk about innovation in indexing, which is obviously something dear to my heart. There are a lot of different dimensions that we are growing and investing in. One is typically when we talk about index solutions, they tend to be single asset class. So, the S&P 500, US equities. There are increasing needs in different places for multi-asset solutions. And so that's an area of active research for us. Things like target date or target outcome is something that is very active for us. But by far, the most work in terms of development and requests from us, like could you build an index that does that, are around the themes of climate-based and other values-based investment concepts. Could I build an index that is, aligned with the goals of the Paris Agreement? Could I build an index that's going to transition effectively to net zero carbon, or integrate other concerns like biodiversity and so on and so on? There's a lot of different needs from different investors, and this is ultimately at its heart, it's a data-based solution. So it's something that is germane and natural to the index world. So there's a lot of interesting things happening in that space, solutions for incorporating different values, if you like, into the investment.
I think that's a really key point, though, in that most of these things, that while they're values, they are data-driven. These are still measurable items, measurable factors. And I think this view probably a couple of years ago even that this was an area or a domain for active management because it required some sort of assessment is probably not actually holding true, in that most of these things should be measurable, because then I guess the benefit of them being able to measure it is that transparency factor. It is about the data. It is about the consistency of application of interpreting that data and applying it within a methodology. Do you see that? Do you see a similar debate occurring more broadly that we obviously have within index and active? But have you seen much tension around the active pushback on this is an area that actually now requires a general assessment by an individual?
Yeah, I mean, I certainly have, and it's sort of stuff I've read. I mean, I personally, I think there is there is some nuance there, and
Yeah.
you know, for example, actually corporate engagement, right? So you know, if you hold the shares of the company to engage with them, I don't necessarily see a difference between someone who's holding their shares because they're in the index or someone who holds shares because they like them. Although I might say that those who hold them because they're in an index, they're probably going to be more of a long-term investor, and so they might be more important for the company to actually listen to them because they'll be around. However, just taking the index perspective and thinking about, you know, can passive work? It is a belief of mine that investing, there's a lot of different ways that you can invest, but if one that is informed by data, one that is transparent, one that is, you know, where analytics are integrated into the process of security selection and measuring and monitoring, I think it's just more likely to deliver the outcome that the investor wants. That's obviously a personal view, but it is why perhaps I'm happy working for an index provider rather than a stock picker.
Yeah, look, I agree on that. I think just sort of wrapping up, looking ahead, do you see any other major changes coming forward, or any sort of things that the market environment is sort of signaling for you guys as an index provider?
I think there's look, life is certainly been interesting in the financial markets in 2022. I do expect that to continue. I think one of the things that we got an acute reminder of this year was the role of energy in the economy, and the possibility that this, whatever it is, 10, 20-year energy transition that we are going to go through, or it seems like we're going to go through, there are going to be bumps along that road. And thinking over the long term about how to navigate that transition from an investment perspective is I think, an important question, and one that investors may be wise to read about, to plan ahead for, and to think about how they manage that risk into their personal lives, but also to their investment.
Yeah. I think one other final just sort of touching points for us is, I guess the looking ahead, or where we're starting to see is, I guess we are seeing at least investors have more choice in this market environment. We are no longer at zero interest rates, so people can start to, or are seemingly looking more at bonds and cash and other tools again for their portfolios, whereas it seemed a conversation a couple of years ago was anything, shares was the only way, right? In terms of investors seeking a return or income. So I think it's good to have those options back on the table for a number of investors. It's a reminder, yes, definitely, that the uncertainty is going to continue, and ensuring that you've got access to the right tools for the right purpose is going to be key.
Yeah.
Look, Tim, appreciate your time today, and obviously sharing some of your insights. For everybody that's watching, I will share a link to the SPIVA webpage. I encourage you to go have a look through that, and do follow up with any other questions, and we'll touch base again soon.
Thank you.
Thanks, Tim.